What if I told you that 2 simple ETFs could generate more income than your 40-hour work week, letting your money work harder than you do, not through get-rich-quick schemes or risky day trading? Feeling like a hamster on a wheel? The average American earns $66,622 annually, trading precious time for money that barely keeps pace with expenses. In this video, I'll reveal a dual-engine ETF strategy that could potentially match or exceed that income, without the morning commute, micromanaging boss, or Sunday night anxiety. If you're tired of the paycheck-to-paycheck cycle, you're in exactly the right place. What if I told you the average American spends 90,000 hours working in their lifetime, yet 70% still live paycheck to paycheck? That's right, nearly a century of your life dedicated to work, and for many, it's barely enough to keep the lights on. It's time we talk about the 40-hour trap that might be holding you back from true financial freedom. Let's get real about traditional employment for a minute. The average full-time job in America pays around $66,622 annually. Sounds decent on paper, right? But there's an invisible ceiling hanging over your head regardless of how early you arrive or how late you stay. Think about it. Most jobs offer annual raises of just 2 to 3%. You work harder, take on more responsibility, maybe even score that promotion you've been chasing. And your reward? A bump that barely outpaces inflation. Meanwhile, the historical average return of the market sits at around 10%, a substantial difference between what your money could earn versus what your time earns. Meet Sarah, a marketing manager who recently told me, "I was working 50-hour weeks, checking emails at midnight, and still feeling like I was falling behind financially. The raises never matched my increasing responsibilities." Her story reflects the brutal math many financial advisors won't mention. If you're 30 years old making $70,000 a year with a 3% annual raise, by retirement at 65, you'll be making about $218,000 annually. But invest just $10,000 at age 30 in the market, earning that average 10% return, like planting a money tree that grows while you sleep, and without adding another penny, you'd have over $452,000 by age 65. That's the mathematical advantage of compound interest over linear salary growth. The financial limitations of the salary model create real-world consequences. When your income crawls while inflation gallops, your purchasing power shrinks year after year. The tax system takes its bite. Income from your job gets taxed at some of the highest rates, unlike certain investment gains. The money you work so hard for keeps shrinking before it even hits your bank account. Job dependence creates a special kind of stress that follows millions of Americans home every night. The anxiety of knowing your entire financial life hangs on maintaining your employer's approval. The burnout from giving your best hours to someone else's dream. The subtle dread of Sunday evenings as another work week approaches. Financial freedom means reclaiming both your peace of mind and your time. Wealth generation statistics reveal something fascinating. The truly wealthy aren't trading their time for money anymore. They've built systems where money works for them through investments, businesses, and assets that generate income whether they're working, sleeping, or on vacation. I'm not suggesting you quit your job tomorrow. What I recommend is building a parallel path alongside your career that harnesses compound growth and passive income. This dual-engine approach can eventually provide more income than your full-time job, with significantly less of your time required. This is where a strategically designed ETF portfolio comes in. By combining 2 carefully selected ETFs, one focused on growth and another on generating income, you create a financial machine that works around the clock. Unlike your salary, which requires your constant presence, this strategy can grow without boundaries while requiring minimal maintenance. Imagine reaching a point where your investments exceed what you earn at work. That's not a fantasy. It's a mathematical reality for those who understand these principles. This dual-engine strategy isn't about having insider knowledge or spending hours analyzing charts. It's about following 4 golden rules that 90% of investors ignore to their detriment. The difference between those who achieve financial independence and those who remain trapped in the 9-to-5 grind often comes down to these 4 principles that are surprisingly simple, yet profoundly effective. Wall Street thrives on making investing seem like a complex recipe with secret ingredients only they possess. They sell expensive funds and sophisticated strategies as essential components. But consider this simple truth. Approximately 85 to 90% of professional fund managers fail to beat their benchmark indices over time. Picture this: a team of experts with advanced degrees and proprietary algorithms consistently underperforming a basic index fund that anyone can buy. Most investors sabotage their returns through 3 predictable mistakes. They chase performance, like jumping from Tesla to GameStop based on recent headlines. They create overly complex portfolios, often owning 30-plus investments they barely understand. And perhaps most damaging, they attempt market timing, selling in panic during downturns and buying during euphoric highs. These behavioral patterns explain why the average investor earns significantly less than market averages. The first golden rule creates your foundation. Start with one broad market ETF, funds like VOO, tracking the S&P 500, or VTI, tracking the total U.S. market. Deliver instant diversification across hundreds or thousands of companies. While an investor might stress about picking the right individual stock, these foundational ETFs have historically outperformed 85 to 90% of actively managed funds, with fees as low as $3 annually per $10,000 invested, compared to $100 plus for many active funds. The second rule personalizes your strategy. Your second ETF must match your specific goals. When your neighbor brags about cryptocurrency gains, remember that your journey is different. If growth is your priority, a small cap value ETF might be appropriate. Need income? A dividend growth ETF could provide increasing cash flow annually. Your second ETF should reflect your personal objectives, not financial media trends. Rule 3 protects you from yourself. Allocate based on your personal risk tolerance. The traditional formula, subtract your age from 110 for stock percentage, provides a starting point. A 30-year-old might have 80% in stocks, while a 60-year-old might have 50%. However, your allocation should reflect your unique circumstances, especially your emotional capacity to weather market volatility without panic selling during downturns. The fourth rule removes emotion from the equation. Consistency beats timing. Research from Vanguard shows that market timers typically earned 1.5% less annually than systematic investors. Over 30 years on a $10,000 investment, that's the difference between $174,000 versus $109,000. By automating regular investments on payday, you leverage dollar cost averaging and avoid emotional decision-making. These 4 rules create the foundation for the specific ETF combinations we'll explore next. They transform complicated investing concepts into actionable steps that help you avoid costly mistakes. Whether you're saving for retirement or building generational wealth, these principles consistently position you to potentially outperform the vast majority of investors, including professionals charging premium fees for their expertise. Portfolio strategy number 1: total market plus dividend growth. The balanced approach. Armed with the 4 golden rules, let's see how they translate into real-world wealth building. You might be thinking, sounds good in theory, but what happens when I actually put money on the line? That's exactly what we're about to explore with our first powerful ETF combination. What if I told you that investing just $10,000 today without adding another penny could potentially grow to over $1.2 million over 3 decades? This is mathematics applied to a thoughtfully constructed 2 ETF portfolio that balances growth and income in a way that Wall Street professionals rarely discuss with everyday investors. Imagine watching your money transform from a modest seed into a vast, thriving forest over time. with each branch and leaf representing compound growth and dividend reinvestment. Let me introduce you to the balanced powerhouse combination, VTI plus SCHD. This pairing represents the perfect marriage between total market exposure and consistent dividend growth. While financial institutions often push complex portfolios with dozens of holdings, this streamlined approach cuts through the noise to focus on what truly matters. VTI, or Vanguard's Total Stock Market ETF, serves as your growth engine. With an expense ratio of just 0.03%, VTI tracks the CRSP US Total Market Index, giving you exposure to over 3,600 stocks across large, mid, and small-cap companies in a single investment. This broad diversification captures the entire U.S. market's growth potential. Over the past decade, VTI has delivered a compound annual growth rate of approximately 12.84%, potentially life-changing when given enough time to compound. Now let's turn to SCHD, the Schwab U.S. Dividend Equity ETF. While VTI powers your portfolio's growth, SCHD brings complementary stability and income to create a dynamic synergy. Currently yielding about 3.56%, it provides a steady stream of cash flow that increases over time. SCHD has demonstrated consistent annual dividend growth of 6.8%, meaning your income stream expands year after year without any additional effort. The magic happens when you combine these two ETFs in the right proportion. Experts typically recommend a 60-40 allocation between VTI and SCHD for a balanced approach. This ratio gives you substantial growth potential while providing both additional diversification and a growing income stream that can be reinvested to accelerate your wealth building. Plus, you'll enjoy tax efficiency as qualified dividends are typically taxed at lower rates than ordinary income, potentially saving you thousands over time. Let's talk numbers. Starting with $10,000 split between these two ETFs according to our 60-40 allocation, and assuming their historical performance continues, though past performance never guarantees future results, your investment could potentially grow to approximately $1.27 million over 30 years without adding another cent. This growth comes from three sources working together: capital appreciation, dividend income, and the compounding effect of reinvested dividends. What's especially powerful about this approach is its simplicity. There's no need for constant monitoring, complex rebalancing strategies, or anxious reactions to market movements. You're harnessing the internet growth of the American economy through VTI, while collecting an increasing stream of dividends through SCHD, a true set it and mostly forget it approach to building serious wealth. Think about what this means for your financial independence. The combination of VTI and SCHD allows you to benefit from both capital appreciation and income generation simultaneously. As your portfolio grows, the dividend component becomes increasingly significant, potentially reaching a point where it exceeds what you might earn from a traditional job, but without the time commitment or stress. Portfolio strategies number 2 and number 3: growth versus income. Financial independence doesn't look the same for everyone. What if I told you there's an ETF combination that could potentially generate more monthly income than the average American salary? Or, alternatively, a pairing that might grow a modest $10,000 investment into $4 million over 3 decades? These aren't theoretical scenarios. They're two distinct paths to financial freedom that cater to entirely different investor needs. Now that we've explored the balance approach with VTI and SCHD, let's examine two portfolio strategies that represent opposite ends of the spectrum. One focused on aggressive growth for long-term wealth building, and the other designed for immediate income generation. Your choice between them reveals your financial personality. Portfolio number 2 combines VOO and AVUV in a 70-30 allocation, creating a powerful growth strategy. VOO exposes you to America's 500 largest companies with a minimal 0.03% expense ratio, Its 22.24% total return over the past year and 23.45% compound annual growth rate provide a solid foundation for growth-focused investors. The portfolio's secret weapon is AVUV, a small cap value ETF with zero overlap with VOO. Its 0.25% expense ratio is higher, but justified by its focus on smaller companies with significant growth potential. When combined, these ETFs create a growth machine capturing returns across the entire market spectrum. A $10,000 investment could potentially grow to $4 million over 30 years. That's the mathematical power of aggressive growth compounded over decades. Consider Sarah, a 28-year-old software developer with time on her side. She's comfortable weathering market fluctuations, knowing she won't touch her investments for decades. For investors like Sarah, temporary volatility matters far less than long-term trajectory. But what about James, who's 58 and wants to generate income within the next few years? That's where portfolio number 3 comes in, the BND and JEPI combination with a 50-50 allocation. This strategy prioritizes stability and consistent income over growth. BND, the total bond market ETF, provides essential stability with its 0.03 expense ratio and 3.68% dividend yield. It's your financial safety net when markets turn turbulent. JEPI, the JP Morgan Equity Premium Income ETF, is the portfolio's income engine, offering a remarkable 7.16% dividend yield paid monthly with a 0.35% expense ratio. This creates consistent cash flow that can transform your financial situation immediately, rather than decades from now. The BND JEPI portfolio won't match VOO AVUV's growth potential, yielding approximately $197,450 over 30 years on a $10,000 investment versus $4 million. But it serves a completely different purpose. You receive meaningful dividend payments right away, potentially scaling to where your monthly income exceeds many Americans' salaries. These contrasting approaches highlight how personal investing should be. If you have decades ahead, the aggressive growth strategy might be ideal. If you're nearing retirement or want immediate passive income, the income-focused combination offers a compelling alternative. Financial freedom might mean different things to you. A massive nest egg decades from now, or the ability to generate substantial passive income sooner. The right strategy depends on your personal timeline and goals. There's no universal answer, just what works best for your situation. So what's it going to be? Will you continue exchanging your precious hours for a paycheck with a built-in ceiling? Or will you put your money to work around the clock? The numbers speak for themselves. Remember our 4 golden rules. Automate your investments, choose low-cost ETFs, diversify wisely, and stay consistent. Financial experts emphasize that starting early, even with small amounts, leads to remarkable growth over time. Automated investing removes emotions from the equation. By setting up regular contributions, you're buying through market ups and downs, potentially boosting returns while eliminating decision stress. These aren't theoretical concepts. They're real pathways to financial freedom. The ultimate reward isn't just monetary wealth, but reclaiming your time and quality of life. Ready to take that first step toward freedom?